Housing to crash 40%? Get into Sydney for 520. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Grab your stein of coffee and let's have a look at this article that Jason Murphy has written for news.com.au, in which he looks at some of the, a recent paper published by the Reserve Bank of Australia, in which they were looking, among other things, at the impact of a 40% house price fall, a decline in values of 40%, and how that would affect the economy. Now let's have a look before we go through what he's done, and I pulled some things out of that paper that you can all get for free on the RBA website. I pulled a few interesting things out of that paper I want to go through. But first, let's have a look at what 40% actually looks like. Okay, and we'll bring this up here using my Excel skills. Now, see this here, I've got the July 31 figures. The July 31 figures for house value, and I will just bring up that chart so you can see the reference. This is from CoreLogic. You can see here, Sydney was at 866. Melbourne is at 600. Why is it doing that every time I zoom in? Melbourne is at 678,000. Brisbane is at 502. Adelaide 441. Perth 439. Hobart 486. Darwin 384. And Canberra at 641. So 40% of that, 40% of the price at 31st of July. So let's say that's what is being lost is there. So Sydney, that's about a 345 grand cut. Melbourne, 270. Brisbane, $200,000 off the median. Remember, these are all median. So it's the number right in the middle, not the average, the median. Adelaide, 176, and Perth, 176. They're relatively close to each other. Hobart is down 194. Darwin, down 150, and Canberra down 256. Canberra's pretty high up there. And I'll just bring up this chart here so you can see how property prices have grown in that time. So we can see that under the scenario that the RBA modeled, a 40% decline in property in Sydney would bring your housing down to, the median down to 519,000, so 520 would change. Melbourne would be down to 407. Brisbane will be down to 301. Adelaide down to 265. Perth down to 263. Hobart be more expensive than Adelaide and Perth. Well, still would be. 292. Darwin at 230 and Canberra at 384. Now, here's another thing to look at. If you have a loan to value ratio of 0.5, and we'll say, just for argument's sake, that this value here is the actual valuation of the property. That's what you borrowed on, for argument's sake. And say, or your LVR just happens to be 50, which is pretty good, 50%. If we take a 40% hit in property, your equity is going to be taking a big hit. Your equity will be down to 86,000. And this is the thing, this is the wealth effect, which they investigate in this paper, in which Jason discusses the impact that that's going to have on other aspects of the economy. One thing that they don't tend to look at in this paper is the psychological impact. They actually have to get data from overseas in their modeling, and just in some of the theories they're testing, because we've had good times for so long here in Australia. We've had good times for so long. What would be the psychological impact of a 40% decrease or hit in property? Is it going to have the same impact on Australians as it would have, say, in the United States or in other countries who haven't had, constant growth forever? That would mean Melbourne, you'd be down to 67 in equity, 50 in Brisbane. But let's say for that loan to value ratio isn't quite at 50. What if it's at 60%? Then all of a sudden, you've got nothing. You've got no equity in your property. You're 1-to-1. But what if, and you know where I'm going with this, 70%? Then you're suddenly in negative equity. You're suddenly in negative equity. 80%? Gets even worse. Or what about those first home buyers going in with a 5% deposit thanks to the government's guarantee? If you did that for the median value in Sydney, and we hit a 40% fall, you could be down $303,000. Now, I don't know about you, but 300 grand is a fair chunk of change. How would those people feel? Would they walk away? How many lives could it hit? I mean, is a 40% even likely? You've got to remember, this is what the RBA tested this because it's similar to falls in other parts of the world. They wanted to ensure, they wanted to check that our banking system could sustain a fall this big to property. That doesn't mean they're saying it won't happen, because they argue that the banking system will be fine, but it doesn't mean it can't happen. It doesn't mean people won't be hit. It doesn't mean people won't be impacted. And that'd have a lifelong effect. So let's jump through and have a look at Jason's take on this. The RBA predicts a potential 40% drop in house prices. And you'll be seeing more and more people talking about this because, frankly, it's dramatic. It's drastic. We've been riding on a wave that's seen us boom for decades, but now it could all come crashing down. New research shows what will happen if house prices fall. The news is bad. It turns out Australia is so puffed up on housing wealth that if house prices fall, they drag down a huge section of our economy with them. And we've been discussing this, well, since I've been discussing property on this channel, when I first realized how much of the wealth of our nation has been invested into property, either directly owning or investment. And actually, that's one of the issues, or one of the points of difference that they raise in this paper. And I'll bring up this chart. I'll bring up this chart that we can see here. So global household debt to income ratios, and they're saying Australia, we've gone from the bottom or the third lowest quartile now to the upper quartile since the 80s. We've grown up. Well, we have, but our debt to income ratios have increased significantly. And the argument the RBA is putting forward is that the Australian market is different. We don't have, over here, everyone who owns a house is usually another family. It's not a business. It's not a co-op. It's not another organization. You don't rent off these rental businesses. You're renting off another mum and dad or someone who's negative gearing a property. So that's why we've got such high household to debt income ratios. And the RBA is arguing, among other things, that because the people who hold this debt are, higher educated and are less likely to lose their job, there's less risk of insolvency. But how's it going to feel if you're sitting on 300,000 negative equity, even if you're highly educated? Are you ever going to be able to dig your way out of that? You let me know in the comments, everyone. The Reserve Bank of Australia put out new research on Tuesday with some dire warnings. RBA investigated the effects of a 40% fall in house prices, a fall they described as extreme but plausible. That would mean a $500,000 home falls to $300,000, a $1 million home falls to $600,000. And I know when you're talking with numbers like this, it's kind of lost. You've got to think how many years of payment that is. I mean, just here, a 300 grand, that's a house. That you would have negative equity in Sydney, where you could buy a house then in pretty much every city except for Canberra and Melbourne. You could buy a house in Brisbane for the negative equity someone has in Sydney if they bought it 95% under this new housing guarantee. Actually, no, I shouldn't say that. The housing guarantee wouldn't be up for that much, would it? It would be only for 700 grand. So saying you could almost get a house for that you've lost in Melbourne, because you could get it in Melbourne. You could definitely get a house in Darwin for your negative equity. They chose that figure because such a fall happened in other countries during the GFC. They also assume rising unemployment, falls, and a share market crash. They then ran a few scenarios to see what would happen. The bank was mostly trying to investigate Australia's record high household debt. As we know, Australians have borrowed up to their eyeballs. We have some very big mortgages, but what they found is a different weakness. And if we have a look here, we can see the stress test. This is what they did. This is their assumptions in their scenario. Because this is economic modeling. They'll they'll get all they'll get all these different variables, they'll model it and they'll test, and you can change all the variables and get different outcomes. Yeah. My concern with this modeling methodology is that there are inherent aspects or limitations to what they can do. Yeah. I think the psychological damage to us could probably be more than people can anticipate. I think it'll be more in Australia than it would be overseas. So employment percentage down 8%, investment income down 30%. So that's all the people who have bought those investment properties, and we're starting to see that materialize. We're starting to see Melbourne listings for rental properties go up 100%. The prices that they're asking for rent going down 10, 17%, depending on where you are. Bonuses and overtime income down 50%. Lending rates, so the interest rate, no change. So the interest rates, it's predicted not to change. We're staying at a cash rate. So in the wealth-related, housing is down 40%. The stock market down 40%. Superannuation and trust funds down 30%. How do you think you'd feel if everything you had, not just your house, your shares as well took a hit? Your super took a hit. Wonder what the price of gold will be under this scenario. Just wondering. So, mortgage defaults. A lot of people worry about mortgage defaults. Here's how that works in theory. If house prices crash, people end up owing more on their loan than their loan is worth. If they default on the loan, the house then belongs to the bank. That can be a problem for the bank. It gets a house that's not worth much, and then there's nobody to pay off the loan. If a lot of people do this, banks can lose so much money they go broke, and the government needs to save them. Or we have the risk of bailing in, which legislation was tried to put through Parliament to explicitly protect people's deposits, but apparently wasn't necessary. However, in Australia, this isn't going to happen, according to the RBA. Our banks, the lucky buggers, will be fine. Even if house prices fall by 40%, they can handle it. About 2 to 3% of people will default on their loans, but that's not enough to send the banks broke. And that's the thing. You'll have people defaulting on their loans, but you'll have a lot of people stuck in negative equity for a long time. And this, a 40% housing hit, that's going to have other impacts to the economy. We're going to be in that V-shaped recovery they've been talking about. I don't think we can bet on that. A lot of banks in other countries went broke during the GFC, and we learned from that. We build up the strengths of our banks. They have something tucked away for a rainy day. They also make some riskier borrowers get insurance called lender's mortgage insurance that will pay out if they stop paying their loan. So, if the RBA calculations are right, we don't need to worry about our banks collapsing. What we need to worry about is something else. One person's spending is another person's income. Household spending is the biggest part of our economy. Household spending means spending by people, not businesses or government, on everyday things like food, education, health insurance and cars, house repairs and renovations. That's the biggest part of our economy. It accounts for 56% of everything that goes on, and it will fall down hard if house prices collapse. They call this the wealth effect. The wealth effect has, for the last 20 years, pushed spending up as the price of houses went up. People whose houses are suddenly worth 2 or 3 times more feel comfortable splashing cash around. In particular, they like to buy nice cars. Well, and we've seen, I'll bring up here, the car sales, have been going down for some time now. But the wealth effect also works in reverse. And here's the argument the RBA are putting forward in this paper, is that it'll be worse going in reverse. It'll have a greater impact. In an economy in an economic crash where house prices fall 40% and the number of people employed falls by 8%, people stop splashing cash around. In fact, people cut their spending to the bare bones. Now, have you done that? Have you already cut your spending to the bare bones? To just prepare. How many people have had to cut their spending to the bare bones just to keep paying their mortgage or just to save for a deposit? That's why I'm concerned that the RBA doesn't take account of the cost of land in their calculations for CPI, which influences the cash rate, because that cost of existing land, it's still taking money out of the expenditure and consumption of people in the economy when they're hoarding it away to save for a deposit. If you're imagining people eating rice with blackened gold margarine for dinner, you're on the right track. The RBA calculates that almost a quarter of households end up at the subsistence level. The share of households consuming at the subsistence level increases from 13% to 24%, they say. That's a frightening thing. You don't want people in a first world country to be stuck at subsistence level. It would mean 1 house in 4 has cut their spending as far as they can. As the next graph shows, the fall in consumption is big, and it hits all the people hardest because they are the ones with the most wealth to lose. The average fall in consumption is 12%. You can see here, this is investment income effect, the employment effect, and the wealth effect. You can see the oldies, 65-year-olds, are taking the biggest hit, and it just goes there. This is the reduction in your consumption. Why is this a surprise? Economists had previously not realized consumption could crash so hard. Even when Australia's banking regulator APRA and the International Monetary Fund had done stress tests to see how Australia copes with a crash, they hadn't foreseen such a large fall. RBA puts it like this: the fall in consumption is much larger than those embodied in previous stress tests by APRA and the IMF in Australia, which also involved severe recessions. The issue is, if we have a big economic event, like a pandemic, that causes unemployment to rise and house prices to fall, that's not the end of the story. The economic decline itself creates a big second wave of effects that makes the economy even worse. One person's spending is another person's income. Well, and we haven't even seen the recession yet, everyone. We've got all these interventions into the market, which are propping up housing. We've got bank holidays for people, even those that are educated, even those that are qualified and are probably considered not likely to be unemployed, who are now suddenly unemployed, going till March. So investment property makes us even weaker. And this is another topic. I discussed it in a previous, every bloody video really comes down to this. Investors are going to be the first ones that fall over, or the first ones that jump. Because why would you hold why would you risk going into significant negative equity on a property that's burning through your money, that you're losing money, that you can't find a tenant for? In places like Germany, investment properties are often owned by cooperatives, the government, or companies. Not here. Here your landlord is just another family. That means when house prices fall, the hit to families is even bigger. It's important to remember that this scenario only exists on paper so far. At the moment, Australia's employment has fallen by 3.2%. That's under half the 8% fall the RBA looked at in its research. And house prices are only down 2.3%, average across the 5 capital cities across the last 3 months, according to CoreLogic, not 40%. The house price fall would have to get a lot more intense to be anything like what the RBA is looking at, and I'm sure the government would step in to try to prevent things getting so bad. And I think Jason's right there. I think they will do every single thing they can. They will chuck the kitchen sink, everything they can to keep houses pumping. That's the final thing I'd like you to take away from this story. Be aware that a crash in house prices would be very bad for the economy. Be aware that we've probably made some bad decisions in making our economy so vulnerable to changes in house prices, and that one day maybe we should reverse some of those bad decisions, but also be aware that the government controls a bunch of economic policies that it may use to help prop up house prices to prevent them falling so far. So that's Jason's take. Now let's jump over to the conclusion of the paper reached from the RBA, just to kind of tie everything together. So this is their conclusion. The long run in household indebtedness has increased concerns about the risks this poses globally to banking sectors and economies more broadly. Given the current level of household debt relative to income in Australia is high compared to many other countries, and its own history, these risks are often highlighted for Australia. Our exploration of these risks shows three implications. First, we find that the high level and strong growth over recent decades of Australian household debt relates to a measurement issue and the strength of the Australian economy. In Australia, the housing rental stock is mostly owned directly by the household sector, and so debt financing is owned directly by households. While in other countries, rental housing is owned by corporations, the government or not-for-profits, and so debt financing is owned by other sectors. Falls in nominal interest rates and the deregulation of the financial system, mostly in the 80s, can account for much of the rise in household debt in Australia and globally. Further, stronger real income growth in Australia compared with many other countries accounts for at least part of the strong growth and so high levels of household indebtedness in Australia. Second, the distribution of debt across households also contrasting implications for risk to the banking sector and household consumption. We show that aggregate bank losses are higher when risks are concentrated among a small group of borrowers. For example, if households in a particular region simultaneously experience large falls in employment and house prices. In contrast, falls in consumption are larger if aggregate wealth effects are dispersed over a large number of highly indebted households. A key driver of this result is that highly indebted households tend to have fewer assets than those without debt, particularly wealthy retirees. An additional factor underpinning this result is that there is a limit to how much households can cut back on consumption in response to wealth shocks. Third, the consequences of household indebtedness seem more likely to manifest through weaker economic growth than large bank losses. Bank stress tests highlight the resilience of the banking sector to severe scenarios, in large part because debt is not concentrated among households with high loan-to-valuation ratios. In fact, most of this debt is held by households whose risk of unemployment is relatively low, while households that are most at risk of experiencing very large changes in asset values relative to income tend to have little leverage. So this is going to hurt the people that can least afford it. However, we simulate some fairly sizable contractions in consumer spending when households are faced with extreme but plausible shocks. This is especially so if precautionary savings motives or loss aversion mean that households are more sensitive to falling house prices than they have historically been to rising prices. Overall, these findings confirm that Australian household indebtedness has important implications, but they are sometimes misconstrued. The level and growth of household debt reflects high incomes and direct ownership of rental properties, not evident of widespread excessive leverage. So I'll read that again. The level and growth of household debt reflects high incomes and direct ownership of rental housing, not evidence of widespread excessive leverage. What do you think about that one? Household borrowing is a large share of banks' assets and so is important for their performance, but overall, high lending standards, low loan-to-value ratios, and banks' high level of capital mean they are highly resilient to adverse shocks to households. Rather, the implications for consumptions of household indebtedness are an important mechanism to take into account when targeting macroeconomic policy to respond to economic shocks. So once again, the concern is not with the banks, everyone. It's how this shock could affect consumption and how that can flow onto other parts of the economy. Are you going to be spending big if you're in deep negative equity? I mean, why don't you let me know your thoughts and opinions in the comments below. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create, there are a few ways you can. You can join the channel on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy a merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, have a great day, and I'll see you next time.